Inflation is up, expenses are up, everything just seems to be getting more and more expensive. So for all of you that are homeowners already, how can you find ways to save money on your mortgage? In this video, I'm going to talk about 5 different ways that you can save money on your monthly mortgage payment. Now make sure you stay until the very end of this video. I'm going to give you one industry secret that not many of you are aware of that can save you a ton of money on your mortgage. So make sure to stay to the end, and I'll give that secret directly to you. If this is the first time you're checking out my channel, my name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you finance your homes all across the country. Whether you're a first-time home buyer, a seasoned investor, or you're simply learning how to manage your mortgage, I created this channel to help you get your mortgage right. You can hit the description below. There's links to more information. Or if you ever need a second opinion, my team and I are here for you. Just shoot me an email and I will give you that free total cost analysis so you can make sure that you are getting the best deal on your home loan needs. And if you find this video helpful, make sure to help me spread the love and share this with your friends and family so that way we can continue to educate more and more people on how to get their mortgage right. We've all felt the pinch lately with inflation going up. Everything is just more expensive and it's beginning to get more and more annoying. I don't know about you, but how many times have you gone to the grocery store or anywhere lately and things are just more expensive? So how do you actually find better ways to save money on your mortgage? Our mortgage is usually our biggest monthly expense. Unless maybe you're like some people that love to eat out and maybe your food budget is bigger than your mortgage. But for most of us, it's going to be our housing payment. Now I'm going to give you 5 ways that you can save money on your mortgage. The first option we're going to take a look at is a simple bi-weekly payment. Now how exactly does this work? In general, what you're going to do is take your monthly mortgage payment and divide it by 2, and you're going to make that payment every 2 weeks, which essentially at the end of the year, you're squeezing in one more payment on your mortgage. But I want to show you how this works because you might think it's not going to have that big of a difference. But let's dive into some numbers so you can truly see how it works. Now, if we just took a $400,000 loan with a 6% interest rate on a 30-year mortgage, you can see here the monthly payment is going to be about $23.98 a month. Now, if you were to take this loan out all the way to its full term of 30 years, you would actually end up paying $463,000 in interest on this mortgage. Crazy. Now, don't let that scare you. So let's take a look at the biweekly payment and how that's a huge benefit. So if you took that $23.98, again, divided that by 2, so now every 2 weeks you're making a payment of $11.99 and 10 cents a month, almost $1,200. Again, if we took this loan the full term, 30 years, never paid it off, never refinanced, you would end up paying $360,785. That would get you a savings of $102,000. Simply by making your payment every 2 weeks. So you can see you'd be able to save over $100,000. Imagine what you could do with that money if you were to then invest it or find other ways to then eliminate some of the bad debt that we all carry. Now, another way that you can save money on your mortgage is simply just making extra monthly payments every single month. Now, this is what I typically do, or I just round up to the next dollar amount in order to make a payment. But again, let's take a look at this same scenario. And we have a $400,000 loan, say we have a 6% interest rate and we're borrowing about $400,000. If you were to just simply make an extra $300 a month on your mortgage payment, you would shave off 7 years and 4 months off of your loan, which would give you a savings of $132,000. How crazy is that? Just an extra $300 a month. This is where in some of my videos I've been talking about budgeting and having a good idea of your finances. Because if you can start eliminating maybe your Netflix account, or maybe you're just not eating out as much, and you can save an extra $200-300, and if it doesn't hurt you to put that towards your mortgage, instead of paying 30 years on your loan, you literally take this down to 22 years. What if you could take $500 a month? Now you've got a 20-year loan because you're going to save 10 years and 5 months, or a total of $182,000 in savings. This is the power of understanding how your mortgage works and how to get your mortgage right, because I'm sure all of us could use an extra $100,000 or $182,000 to invest, or maybe you're putting that towards your kids' college fund. Our next strategy is to remove your private mortgage insurance or your PMI. Now, you probably have this if you have an FHA loan, or if you didn't put 20% down, or your lender didn't structure your loan to eliminate your mortgage insurance up front. Mortgage insurance goes to absolutely nothing. A lot of you might hate it, might talk bad about it, but I don't necessarily think mortgage insurance is horrible, especially if it means you getting into a house and you're paying it temporarily because you have all the upside of the appreciation in the home. Now, if you can remove it, the one thing that any lender is going to look at is your loan to value or your LTV. So this is an easy way for you to do this math at home. And all you really need to figure out is what you owe on your property, which that's easy to do. Just take a look at your mortgage statement. Then you want to look at your property value. What is it worth today? Now you might look at Zillow and Redfin and think that's what your home is worth. That's a good ballpark, but it's not the end all be all. Take it with a grain of salt. Let's just say you do owe $400,000 on your house and your house is worth $500,000. You would be at an 80% LTV. 400,000 divided by 500,000 gives you that number. At that position, you would be in a great place to be able to remove your mortgage insurance. Now, if you're unsure of how to do this calculation, you can always reach out to myself and my team. We can help you. This is what we love to do. All I need is your mortgage statement, and then we can start to calculate and do a free analysis for you. The next thing that you want to take a look at is what type of refinance are you looking to do? So some of you want to tap into your home equity and pull your cash out. Remember, this is a dangerous thing to look at in today's market. And the reason is, if you're taking cash out to go renovate your house, I'm not a big fan of that because you're taking out equity of your property, which means you're going to probably increase your mortgage payment to fix up your house, which is not going to create cash flow for you. So unless you're making a lot of money, and unless you're in a position where increasing your mortgage by $500 is not going to kill you, hey, that's your decision to make. But I'm not a big fan of doing that today. I'm in a more cost savings mentality right now, and I'm looking for ways to create more passive income. So if you're going to take the money out of your house to invest into a business or invest into an opportunity that's going to bring you a greater return, I'm all for that. But remember, you want to be able to refinance it into a position where you're still not going to have to pay your mortgage insurance, because that money is an insurance policy on your house. In case you foreclose, the bank can get some money back. It doesn't go to benefit you and your mortgage. So that's why you want to try to eliminate that as fast as possible. And that is typically done through a refinance. And number 4 is a streamlined refinance. So a streamlined refinance applies to FHA and VA loans. The VA loan, it's called an IRRRL or an IRRL, but in the industry, we just call it an IRRRL refinance. And the cool thing about this type of refi is that you don't necessarily need an appraisal to do it. And it's very, very fast for most lenders to accomplish this. But in this market that we're in today, this might be a little tough to come by because most of you probably refinanced your house in the last couple of years. So if you did, you can skip over this and make sure you stay till the end, because I'm going to give you the last tip that will save you a ton of money on your mortgage. But for those of you that did not refinance in the last few years for whatever reason, and you still have a higher interest rate mortgage, you could look at a streamlined refinance with a lender to where all they're going to do is reduce the interest rate on your mortgage. So again, that just depends on what your current interest rate is, because rates today are a lot higher than what most of you currently have. So that may not be an option. But if you're unsure, you can reach out to your lender, your loan officer who did your loan, or you can give us a call and we can definitely see if that is an option for you. It's a lot more cost effective and time efficient as well to save you money on your mortgage. But remember, that's for VA and FHA loans. All right. And the tip that you've all been waiting for, this is the one thing that a lot of people in the industry, a lot of lenders don't talk about. This strategy is called a recast. And why this is so cool is that, let's just say you came into a lump sum of money. It could be $20,000, $50,000, or maybe you're self-employed, you sold your business, and now you got this extra cash laying around. You can put a large lump sum towards your mortgage, and your lender will readjust your payment based on however much money you're bringing to the table and whatever the new loan balance is. Now, the great thing about it is that it doesn't reset your loan back to 20, 30 years or whatever the term initially was. And it also doesn't change your interest rate. So you are being able to reduce the loan balance and reduce your monthly payment by doing that. Now, the caveat to this is you have to figure out with your servicer, the company that you're making your payments to, how much money they require in order to do a recast. I looked at doing this on one of my properties several years ago, and the minimum that the servicer wanted was $50,000. Every lender is going to be a little different, so don't take that as gospel as what I'm sharing with you. make sure to contact your servicer. And again, your servicer is who you make your mortgage payments to. They are going to be the ones that will tell you whether it's 20 grand, 50 grand, however much the number is. But that's the one thing a lot of lenders don't share with you, because most people want you to refinance, because a loan officer is going to make money and everyone else gets to make money off the deal. The recast, you deal directly with the lender, and you are essentially saving yourself a ton of money on your mortgage, saving your payment, and paying your house off that much faster. So share these 5 tips with your friends who are also homeowners so they can also save money and get through these tough times that we're dealing with in the economy. Thanks so much for watching, and I'll see you in the next video.